Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. This week up, Charter Communications. It's a trifecta. Let's get to work. Now, before we get into Charter, we're going to review Charter with the 5 key factors that we use here at this channel to underpin the beginning of our analysis, right? You want to have 5 key elements that we use to judge other stocks against each other, to then pick the best of the best and go dive into those. So the 5 key factors for us are, number 1, top line revenue growth, gotta be there. Number 2, earnings growth. We want enterprise level earnings to be growing. Number 3, strong free cash flow. It's the motto of the show. Number 4, low debt, that's less than 3 times debt to EBITDA. And number 5, a well-priced stock. What is a well-priced stock? It's a conservative forecast going out in time that will beat the market. That's it. It's simple, it's hard to do. Let's figure out if Charter can do it. Behind me is the 10K. Let's go through quickly, or at least this is our annual report. Let's go through quickly and see what does Charter do. I'll let you read the entire thing on your own, but for right now, let's just talk quickly what essentially they do. Well, between 17 and 21, they spent over $40 billion on infrastructure of network capacity of 800,000 miles spanning 41 states to deliver 1 gig internet speeds to a whole host of customers. And if I fast forward here to give you a quick snapshot of what the business has done recently, revenue has been growing, adjusted EBITDA has been growing, and customer base has been growing. Now, a lot of people I know you're going to go to the Starlink for Elon Musk and the SpaceX and some of the fiber optic networks that Google has laid, although they canceled that. That was a failure. There have been a lot of competition out there, but what I like about Charter is that the network is already installed in the ground. They don't have to come out of pocket to support that infrastructure. It's already installed. All they have to do is just continue to feed the customers, and the customers will continue paying them for that network. And I think that installed capacity is a barrier to entry or is a moat. So I wanted to take a look at the stock and see what it has done. The stock is down significantly recently. Let's figure out how much cash this stock makes and take a look at their financial returns. And with that, we're going to drink a little Ardbeg because it's way too late. I should be asleep. I'm not. I'm doing stocks for you guys. Here's a little Ardbeg just for you. Cheers. Ooh, that's good. I will be in Scotland, by the way. If anybody wants to join me for a wee dram, ping me in the comments down below. Maybe we can link up. Okay, here we go. 2013 for Charter, $8 billion of top-line revenue. This is before they bought Time Warner Communications. So you're going to see a nice growth here prior to the merger or the purchase. So they're still growing organically. Then they buy Time Warner, and they're here. And the post-acquisition world, I'll even pick up here, post-acquisition world, they continue to grow. So I think this checks our box for the growth of revenue. All right, EBITDA has been growing as well. So the same pattern here. You've got growing EBITDA before the acquisition of Time Warner, and then growing EBITDA after the acquisition of Time Warner. Even I've got low, mid to upper single-digit annual growth rate in EBITDA, which is nice for that period of time. These consolidated annual growth rates here don't really matter because it's referencing pre-acquisition and post-acquisition, so it's overstating it. But if you just look at the growth rates in between here, it's definitely positive, definitely checks the box for us. Let's take a look at enterprise value. Enterprise value always begins with debt. And we want to figure out how much debt this company has. And you can see prior to the acquisition of Time Warner, they had about $35 billion. And then they levered themselves up a lot to go get that deal, double the debt. And that debt has continued to grow, probably because they've been investing that $40 billion in infrastructure that I referenced earlier in the video. That costs money that you can finance. Let's check that. But that's how this has been growing. Good thing is earnings have been growing as well to support this debt. So I would expect the debt ratio to have probably stayed roughly the same. We'll see how it pans out. No excess cash to speak of. Market cap has gone from, $12 billion to $124 billion. That's basically the rise of the acquisition that they made, which was very expensive. You can see the delta here, or maybe here's a better representation of the total price that they paid for Time Warner. But the stock's at $124 billion. That is average market price times shares outstanding. I use fully diluted shares. And then I get enterprise value and I add debt plus market cap. That's the entire value of the business. all debt and equity. That's what you want to look for, is what the total company is worth. And I'm going to skip the pre-acquisition era. So it's been $128 billion to $215 billion of value. 215 is the number you want to chime in at. We're going to see what this number is right now, given the collapse in the stock here at this company. And then the average trading range, this is enterprise value to EBITDA. This is a rough payback period, or a way to equate total value with earnings by dividing the two. We can see what range it trades in, and you can see on the low end, it's traded 9.5, 9.3. That is 2 times in the last 9 years that it's hit that low of a mark. It's also been as high as 17 times. That's probably on the announcement of the merger. It probably jumped because they were anticipating all the earnings. That's probably a little too high, but 12 times is definitely kind of a high. So you're looking at low 9 to 12 times range on an enterprise value multiple. On the debt side is a wee bit too high for us. That is a little bit high. Certainly after the acquisition, when it spiked to about 6.6, 4.8, they've been working to bring it down, and they are doing that. I think they've stated that they wanted to have a 4 times leverage ratio as their long-term. Sorry, just referencing. Yeah, adjusted EBITDA remains at 4 to 5 times. The debt, they are looking to get below 3. So they're going to spend a little bit of their free cash flow to buy that debt down in the future. That's into our range. They're stating that they want to be at or below 3 times debt to EBITDA. That's going to happen over time as they chip away. And we're going to say, okay, management, we believe you're going to unlever the company. That's what's called unlevering the company, buying down debt. And I like that. 4.6 is high, not impossibly high, but it's something to definitely note. 6, 5, 10 times, that's too high. Okay, that is the rough revenue and EBITDA. Let's take a look at cash flow. That's what we're here to do. Cash flow from operations, where the rubber meets the road. This is how much cash money they get from their customers, providing the service, paying their employees, really the essence of running the business. 2.1, $2.3 billion. The acquisition happens, and it grows to $16 billion. This is good growth that they're experiencing post-acquisition. I like to see that. Sometimes people make really, really big acquisitions and it goes south. They're not able to grow it. They seem to be able to grow EBITDA and free cash flow, which is or cash flow from operations, post-acquisition, which we like. Next, CAPEX. What I want to see, obviously, is the spread here, that they can afford this. About $10 billion left over every year. Well, it's like growing. It's maybe $4 billion here, 5 or 6, and then $7 billion. It's going to be $10 billion. Rough math, sorry. Left over after CAPEX. What CAPEX is what they've put back in their business. So when they're investing $40 billion in infrastructure, that's these chunky numbers here that they're putting back into the business. Debt, right? They levered their business up, and they continue to do so. Here, they're most likely to be buying this down in the future. They're also going to grow into the debt, it looks like, as well. I add this up, and I get total free cash flow to the enterprise level. That's what we want to take a look at. Now, what I'm going to do is I'm going to pull out this debt, $8.8 billion, because I don't want to rely on this number here as 17, assuming the 8.8. That would mean that they're going to borrow $8.8 billion every single year out in the future. That's not realistic. To be conservative, I'm going to take these two numbers and I'm going to say, well, that's roughly $10 billion, whatever the math is, and I'm going to divide that by the shares outstanding, and I'll run that into the future to not re-lever the business. Total shares outstanding have been coming down recently, as they've been kind of peeling, using some of the free cash flow to buy back shares. I like that. Free cash flow per share is strong. I think it's roughly $40 if I adjust for this $8.8 billion. It's $40 of free cash flow. It's positive. It's large. I like that. Let's put it on relative basis, so it's relative to the shares. And I'm here with a yield. I'm going to go over one more. This is basically the yield with no debt payment, because the debt was positive every year. It's skewing the cash flow to the enterprise level, and I want to remove that to be cautious. And I'm going to say it's been yielding 3 and 4% historically. It's averaged 4.3. Last year, it was yielding 7%. Let's see what it's yielding right now. Ready? Let's go ahead and forecast this business. Okay, now we want to forecast EBITDA. And what I'm going to do is I'm going to say $20 billion, $20.8 billion is EBITDA out to next year, 2022. And when I look at the 10K, the most recent 10K, the quarterly result as of March for Charter, they grew revenue 5% year over year. So I'm going to give it a 5% growth year over year in earnings for Charter for 2022 because if I look historically, you've got 10% post Time Warner acquisition for EBITDA growth. Excellent. So I'm using 5. It was 6, 6, 10, 10. 2, this is a cable internet provider, and I think with a recession possibly looming, that's going to affect the outside retail, the go out dining experience from the individual cable provider, customer. They're going to stay home with a home cooked meal, put Netflix on, put Disney Plus, they're going to put Amazon Prime and save the money, but they're going to make their cable bill because they want the internet connection. So I think this is a nice recession-proof, not proof, but resilient company. I'm going to give it a 5% target out, growth target for 10 years. That means a $32 billion annual EBITDA in 2031. I will give it a 10 times market multiple to give it a little bit of conservativeness. And I'll remind you, the market multiple range from 9.3 to maybe, I think it's 12 times, averaged of 12. It's only been as low as that for twice the last 9 years. I'm going to say it 10 times to give it some conservativeness. That's going to be an enterprise value of $323 billion, less the debt that they currently have, just going to hold it constant, even though they'll probably pay it down. That's $232 billion of market cap. Divide by the 193 shares outstanding gives me $1,200 price target for Charter Communication out 10 years from now. All right, let's take a look at free cash flow and see what we do. Oh, sorry, I got lost there. That's just fantastic stuff. All right, here we go. Let's keep going. $46 is the price target for free cash flow out. Wow, that's fantastic. Out next year, basically the 5% growth over last year's free cash flow, excluding the debt that was borrowed. I'm going to grow that money over time. I'm going to apply a 4.6% yield on it. That yield is higher than the yield I have historically. Higher yields means more conservative, right? Higher multiples are less conservative. Higher yields is more conservative. That gives me a price target of $1,578 out 10 years for Charter based on a free cash flow method. Okay, this is the fun part. Let's bring it home, all right? I can buy as much stock as I want right now at $435 a share. I've got 2 price target estimates. One, free cash flow method, $1,587. I've got another one, $1,202. I'm going to average it for $1,390. Now, if I take this current price times the shares outstanding plus the debt, I get an enterprise value of $178 billion. Now, if I remind you what it was trading last fiscal year before the pull down, 215. That's come down, what's that, $30 billion of haircut? That's a nice haircut that's come down in price. Now, earnings are growing. So earnings is higher forecasted than the last year, $20 billion. If I divide these two, it's trading at 8.6 enterprise value to forward EBITDA right now, which is a new low for the stock. Lowest we saw before was 9 and change. On a cash flow yield, if I take that $46 of next year free cash flow, divide it into my stock price, it's a 10% yielding stock. What does that mean? That means if the stock price does not go anywhere in a decade, but the business hits the cash flow numbers it's going to, that means that your percent ownership in that business is yielding you 10% free cash flow. They have to do something with that money. They're going to dividend it out, in which case you get it. They're going to buy back shares, in which case the share price rises. They're going to go make acquisitions, in which case the share price should rise because they're accretive. They're going to do something to represent that value to you, and over the long term, you're going to realize it theoretically. So I really like where it's setting up. Let's pop this into an IRR now and see what it looks like from an investment return perspective. Okay, here we are with the IRR. So these are my cash flows, my pro rata share of earnings. I get I buy the stock at $453. I sell it at $1,400 in change, and that is a 24% annualized return on your money. That's 24% every year on your money for a decade. Now, obviously, that includes this cash flow, which is going to be distributed, used to buy back stock or go make acquisitions. It's not all an entire dividend, but it is your fractional ownership in the business. And a 24% return is a very, very strong return for a stock. All right, if I were to put this into a distribution for you, it's currently trading at $435. It's yielding 25% IRR. If the stock price rises and the rest of the forecast stays the same, the stock IRR is expected to drop. But I'm still a buyer here. I like that stock. If the stock price continues to fall, it gets even more attractive. So let's review our 5 key attributes. Number 1, top line revenue growth. Yes, check the box. Number 2, earnings growth. EBITDA is growing. Check the box. Number 3, strong free cash flow. Absolutely. Number 4, low debt. Yes, I'm going to check the box. It's on the cusp. It's getting a little high, but they're saying they're going to bring it down. I'm going to go ahead and check the box, acknowledging that it is slightly higher than 3 times. And number 5, well priced. Yes, I think it's well priced. A 25% IRR project, one of the highest projects that we post here on the channel. I think it's all a matter of this market melting down and people throwing the baby out with the bathwater. So this gets a good from us. I also want to acknowledge the t-shirt I'm wearing, the trifecta t-shirt. This is the t-shirt that I wear on stocks that I think meet an extra level of criteria. That is a trifecta. What is a trifecta? It's the combination of 3 things that compound to really move the needle on the stock. If you've checked out my Domino's versus Google video, where I looked at the IPOs of the 2 stocks for a 15-year investment horizon, Domino's Pizza outperformed Google as an investment. Why? Because Domino's paid a dividend, Domino's bought back shares, and they reinvest the earnings, and that compounded over time. And what happens is it's a trifecta. That's my word. That is earnings growth, which is what's happening. Got earnings are growing, even if it's slow, it's still growing. Share buyback, they're buying back stock, and a market multiple expansion. You can buy it right now, what I say, at 8.6 times. 8.6 times. I think it's going to trade later on in the future at 10 times in the forecast. That's how I get my long-term price. But it's traded as high as 12 times. So that expansion means I have growing earnings. Each earning that I get in growth is then multiplied by a bigger number, 10 to 12 times. And there are fewer shares outstanding as the stock gets purchased. So my percentage ownership of this increasingly valuable company also increases. It's a very, very attractive risk-reward trade-off. It's why I like the stock. I own the stock, and I think I'm going to buy some more at this level. Warren Buffett's in the stock. I can see why. If you like this type of work, I do want you to check out the link in the description below and check out my website, cashflowinvestingpro.com. I teach a course where I can teach you how to do just this. I give you this Excel financial. I give you 3 hours of content of me walking you through 6 different courses on how to read 10Ks, how to pull out revenue, EBITDA, debt, free cash flow, how to build a forecast, what market multiples are, how to build a portfolio of, say, 10 to 30 stocks that over your lifetime could truly outperform and be the best of the best. That's the idea here. You can go buy the SPY index and you're going to get one of 500 companies. You're going to get all 500 companies, and you're going to get the good ones along with the bad ones. And what I'm trying to do, and that this blog is my diary of, is me trying to identify the top very best of the best stocks. And that's what we want to try to find. Find those. My course helps you do that. Please take a look. You can also subscribe to the Cash Flow Club. The Cash Flow Club is in the upper left corner of the website when you log in. And I give one-pagers, just like this one. The Cash Flow Club has had this stock now for a while. You get 10 years of financial information. I'll do a clean one. You get 10 years of financial information. You get my summary of the 5 key attributes. You get a forecast. You get the IRR and a write-up. And what I do is I find a company that I think meets the 5 criteria. I think it has the trifecta effect, and I print it off and I set it aside and I watch that stock and I buy it if I like it. If I find a stock that I like but it's not the right price, I print it off, I set it aside and I wait for it. That way, if the market turns like it's turning right now, you can more quickly thumb through the very best of the stocks that you've already researched and already know. You can quickly find the very best ones, check the price. If they're good, you buy them. You don't have to do the fresh research all the time. You've already studied the stocks. You have your wish list, the stocks that you're going to buy when the stock market collapses. Here it is, it's collapsing. Let's go hunting. Now is the best time, in my opinion, to begin learning to value stocks. Buy them for yourself, especially if you're young. The type of knowledge that I give you in the course will pay off for the rest of your life. You can download a free one-pager on my website. There's a link in the description of the video below. Thank you very much for the time. I really appreciate it. I do like Charter. I think it hits the 5 factors and as well as the trifecta. Let me know what you think down below in the comments. I'd love to hear other stocks that you're interested in valuing. Join the Cash Flow Club. We're having lots of discussions. Or take the course and learn to become an analyst yourself. Thank you very much for the time. Again, if you're in Scotland and you want to ping me in the description below, I'm happy to chat offline. Maybe meet up at a pub someplace, grab a dram. If you need anything else from me, you can reach me. Thank you very much. My name is Cameron Stewart, CFA. This is Rational Investing. Is gonna pop a couple videos of other value stocks that I like and think are interesting. Take a look. Cheers. Talk to you later. Bye-bye.